What if I told you that every dollar the Federal Reserve prints today makes the economy weaker, not stronger? That sounds impossible. For decades, the playbook has been simple. When crisis hits, print money, lower rates, save the system. In 2008, it worked. In 2020, it worked. But in 2025, something has changed. The mechanism is broken. There's a pattern that has emerged 3 times in modern economic history, and each time it led to the same outcome. Economic stagnation lasting over a decade, deflation spiraling out of control, and entire generations watching their wealth evaporate, despite central banks flooding the system with money. The United States in the 1930s, Japan in the 1990s, and now the global economy in 2025. This is not speculation. This is mathematics. The data reveals a terrifying truth. The velocity of money in the United States has collapsed from 2.2 in 1981 to 1.12 in the second quarter of 2024, a 49% decline. The U.S. debt to GDP ratio stands at 120.9% as of June 2025, approaching levels not seen since the immediate aftermath of World War II. And the Federal Reserve's balance sheet, despite quantitative tightening, remains bloated at unprecedented levels. We are standing at the edge of a liquidity trap. This is the story of why printing money won't save the economy this time, why central banks have lost their most powerful weapon, and what happens next when conventional monetary policy becomes completely impotent. Let's start with March 4, 1933, Washington, D.C. Franklin Delano Roosevelt takes office as the 32nd President of the United States. The nation is drowning. Unemployment has reached 25%. Industrial production has collapsed by 46% from its 1929 peak. And prices are falling at a rate of 10% annually. Deflation so severe that the real burden of debt is crushing businesses and families alike. At that time, the United States operated under the gold standard, a monetary system that required every dollar in circulation to be backed by physical gold reserves. The Federal Reserve Act mandated that 40% of all Federal Reserve notes issued must be backed by gold held in the central bank's vaults. This created a rigid constraint. The Fed could only expand the money supply if it had sufficient gold reserves. By the late 1920s, the Federal Reserve had almost hit the limit of allowable credit backed by its gold holdings. But here's what actually happened between 1929 and 1933. The money supply contracted by approximately 30%. Commercial banks failed by the thousands. Over 9,000 banks collapsed during this period, wiping out the savings of millions of Americans. And the Federal Reserve, bound by the gold standard, could not expand the money supply to offset the deflationary spiral. Any reduction in the gold held in Fed vaults required an even greater reduction in credit extended to the economy. This happened because of a fundamental mechanism. Under the gold standard's price-specie flow mechanism, countries that experienced gold outflows, capital flight to nations perceived as more stable, were forced to contract their money supply to maintain the fixed gold-to-currency ratio. Think about what that means. When confidence collapses and investors move money abroad, the nation loses gold. Losing gold means the central bank must reduce the amount of currency in circulation. Reducing currency means deflation intensifies. Deflation makes existing debts more expensive in real terms. Rising debt burdens cause more bankruptcies. More bankruptcies destroy more wealth and confidence, and the cycle repeats. The data demonstrates this with brutal clarity. Between 1929 and 1933, wholesale prices in the United States fell by approximately 32%. If you were a farmer in 1933, the wheat you could sell for $1 in 1929 now fetched 68 cents, but your mortgage payment remained exactly the same. The real interest rate, the nominal rate adjusted for deflation, reached extraordinarily high levels, 4.57% in 1930, and an astonishing 10.38% in 1931. These were not low rates designed to stimulate borrowing. These were punishingly high real rates that made borrowing impossible and saving rational. This created a situation where monetary expansion became impotent. Between 1933 and 1936, the Federal Reserve massively expanded the monetary base. The index grew from 68.1% to 96.3% relative to 1929 levels. The nominal interest rate dropped to near zero, fluctuating between 0.05% and 0.014%. The central bank had done exactly what economic theory prescribed. It flooded the system with liquidity and drove interest rates to the zero lower bound. Yet the economy remained trapped. This is the essence of a liquidity trap. When nominal interest rates reach zero, but deflation persists, the real interest rate, what borrowers actually pay and lenders actually earn, remains positive and potentially high. In this environment, increasing the monetary base has no effect because base money and bonds become perfect substitutes from the perspective of private investors. Why invest in risky ventures or lend to businesses when holding cash guarantees you a positive real return through deflation? Why borrow at any nominal rate when prices are falling and your debt burden increases in real terms every month? If you were a business owner in 1934, your calculation was simple and devastating. You could borrow at a nominal rate near zero, but with prices falling 5% annually, your real borrowing cost was 5%. Meanwhile, sitting on cash generated a 5% real return without any risk. The rational choice was to hoard cash, not invest. And when everyone hoards cash simultaneously, aggregate demand collapses further, intensifying deflation and validating the decision to hoard. The economy locks into a self-reinforcing downward spiral. The incomplete and erratic recovery from the Great Depression can be traced directly to the failure to pursue consistently expansionary policy while trapped at the zero lower bound. On April 5, 1933, President Roosevelt signed Executive Order 6102, making private ownership of gold certificates, coins, and bullion illegal. This was not a symbolic gesture. It was an attempt to break the gold standard's stranglehold on monetary policy, to give the Federal Reserve the freedom to expand the money supply without triggering gold outflows and forced contractions. The pattern emerged clearly. Stage 1. An external shock triggers asset price collapse and banking crisis. Stage 2. Deflation sets in as credit contracts and the money supply shrinks. Stage 3. Central banks lower nominal interest rates to zero. Stage 4. Deflation continues, keeping real interest rates positive and high. Stage 5. Monetary expansion becomes impotent because cash and bonds are perfect substitutes. Stage 6. The economy remains trapped in stagnation for years, sometimes decades, until the deflationary psychology is finally broken through unconventional means or external shocks like war. The United States did not truly escape the liquidity trap until the massive fiscal expansion and industrial mobilization of World War II fundamentally altered expectations and forced money into circulation through government spending on an unprecedented scale. Monetary policy alone had proven insufficient. The printing press had stopped working. Let's start with March 4, 1933, Washington, D.C. Franklin Delano Roosevelt takes office as the 32nd President of the United States. The nation is drowning. Unemployment has reached 25%. Industrial production has collapsed by 46% from its 1929 peak. And prices are falling at a rate of 10% annually. Deflation so severe that the real burden of debt is crushing businesses and families alike. At that time, the United States operated under the gold standard, a monetary system that required every dollar in circulation to be backed by physical gold reserves. The Federal Reserve Act mandated that 40% of all Federal Reserve notes issued must be backed by gold held in the central bank's vaults. This created a rigid constraint. The Fed could only expand the money supply if it had sufficient gold reserves. By the late 1920s, the Federal Reserve had almost hit the limit of allowable credit backed by its gold holdings. But here's what actually happened between 1929 and 1933. The money supply contracted by approximately 30%. Commercial banks failed by the thousands. Over 9,000 banks collapsed during this period, wiping out the savings of millions of Americans. And the Federal Reserve, bound by the gold standard, could not expand the money supply to offset the deflationary spiral. Any reduction in the gold held in Fed vaults required an even greater reduction in credit extended to the economy. This happened because of a fundamental mechanism. Under the gold standard's price-specie flow mechanism, countries that experienced gold outflows, capital flight to nations perceived as more stable, were forced to contract their money supply to maintain the fixed gold-to-currency ratio. Think about what that means. When confidence collapses and investors move money abroad, the nation loses gold. Losing gold means the central bank must reduce the amount of currency in circulation. Reducing currency means deflation intensifies. Deflation makes existing debts more expensive in real terms. Rising debt burdens cause more bankruptcies. More bankruptcies destroy more wealth and confidence, and the cycle repeats. The data demonstrates this with brutal clarity. Between 1929 and 1933, wholesale prices in the United States fell by approximately 32%. If you were a farmer in 1933, the wheat you could sell for $1 in 1929 now fetched 68 cents, but your mortgage payment remained exactly the same. The real interest rate, the nominal rate adjusted for deflation, reached extraordinarily high levels, 4.57% in 1930 and an astonishing 10.38% in 1931. These were not low rates designed to stimulate borrowing. These were punishingly high real rates that made borrowing impossible and saving rational. This created a situation where monetary expansion became impotent. Between 1933 and 1936, the Federal Reserve massively expanded the monetary base. The index grew from 68.1% to 96.3% relative to 1929 levels. The nominal interest rate dropped to near zero, fluctuating between 0.05% and 0.014%. The central bank had done exactly what economic theory prescribed. It flooded the system with liquidity and drove interest rates to the zero lower bound. Yet the economy remained trapped. This is the essence of a liquidity trap. When nominal interest rates reach zero, but deflation persists, the real interest rate, what borrowers actually pay and lenders actually earn, remains positive and potentially high. In this environment, increasing the monetary base has no effect because base money and bonds become perfect substitutes from the perspective of private investors. Why invest in risky ventures or lend to businesses when holding cash guarantees you a positive real return through deflation? Why borrow at any nominal rate when prices are falling and your debt burden increases in real terms every month? If you were a business owner in 1934, your calculation was simple and devastating. You could borrow at a nominal rate near zero, but with prices falling 5% annually, your real borrowing cost was 5%. Meanwhile, sitting on cash generated a 5% real return without any risk. The rational choice was to hoard cash, not invest. And when everyone hoards cash simultaneously, aggregate demand collapses further, intensifying deflation and validating the decision to hoard. The economy locks into a self-reinforcing downward spiral. The incomplete and erratic recovery from the Great Depression can be traced directly to the failure to pursue consistently expansionary policy while trapped at the zero lower bound. On April 5, 1933, President Roosevelt signed Executive Order 6102, making private ownership of gold certificates, coins, and bullion illegal. This was not a symbolic gesture. It was an attempt to break the gold standard's stranglehold on monetary policy, to give the Federal Reserve the freedom to expand the money supply without triggering gold outflows and forced contractions. The pattern emerged clearly. Stage 1. An external shock triggers asset price collapse and banking crisis. Stage 2. Deflation sets in as credit contracts and the money supply shrinks. Stage 3. Central banks lower nominal interest rates to zero. Stage 4. Deflation continues, keeping real interest rates positive and high. Stage 5. Monetary expansion becomes impotent because cash and bonds are perfect substitutes. Stage 6. The economy remains trapped in stagnation for years, sometimes decades, until the deflationary psychology is finally broken through unconventional means or external shocks like war. The United States did not truly escape the liquidity trap until the massive fiscal expansion and industrial mobilization of World War II fundamentally altered expectations and forced money into circulation through government spending on an unprecedented scale. Monetary policy alone had proven insufficient. The printing press had stopped working. Japan's 3 lost decades, the modern blueprint. Now let's examine what happened on December 29, 1989, in Tokyo. The Nikkei 225 stock index reaches its all-time peak of 38,915 points. At that moment, Japan appears unstoppable. The second largest economy in the world, real estate values in Tokyo that defy logic, and a banking system that seems invincible. But the collapse has already begun. Trying to deflate speculation and keep inflation in check, the Bank of Japan sharply raised interbank lending rates in late 1989. This sharp policy reversal caused the bursting of the asset price bubble. The Japanese stock market crashed, losing more than half its value within 2 years. Real estate prices collapsed, and equity and asset prices fell, leaving Japanese banks and insurance companies with balance sheets full of bad debt, loans backed by collateral that had lost 50, 60, sometimes 70% of its value. At that time, Japan's economy was built on a foundation of high leverage and asset price appreciation. Businesses had borrowed heavily against inflated real estate values. Banks had lent aggressively, assuming property values would continue rising indefinitely. When prices reversed, the entire structure became unstable. But here's where it gets even more interesting. The deflationary spiral that followed was not caused by a sudden contraction of the money supply like in the 1930s United States. Instead, it was driven by expectations. The Bank of Japan gradually lowered its policy rate throughout the 1990s, introducing a zero-interest rate policy in 1999. This marked the start of Japan's unconventional monetary policy experiments. Although the BOJ ended its zero-interest rate policy briefly in 2000, it reintroduced quantitative easing in 2001 in the wake of the bursting of the IT bubble in the United States. For more than 2 decades, Japan maintained nominal interest rates at or near zero. For more than 2 decades, the Bank of Japan expanded its balance sheet through asset purchases. For more than 2 decades, monetary policy followed the textbook prescription for escaping deflation. Yet, deflation persisted. From 1995 through the late 2010s, Japan experienced ongoing declines in wholesale prices and land values. The deflationary psychology gripping the economy created a devastating dynamic. Households and businesses anticipated continued price declines, which made delaying purchases and investments the rational choice. This reduced aggregate demand. Reduced demand validated the expectation of falling prices. And the cycle continued, year after year, decade after decade. This happened because real interest rates remained too high to stimulate aggregate demand, despite nominal rates at zero. Think about what that means for someone living in Japan in 2005. The Bank of Japan offers you a loan at 0.5% nominal interest. Sounds attractive, but prices have been falling at 1% annually for years. Your real borrowing cost is 1.5%, higher than many nominal rates during periods of mild inflation. Meanwhile, if you simply hold cash, You earn a real return of 1% per year as deflation increases the purchasing power of every yen you save. Why borrow to invest or consume when hoarding cash generates a positive, risk-free, real return? The pattern repeated with mathematical precision. Japanese households increased their savings rate despite zero interest rates. Businesses sat on record levels of cash rather than investing in expansion. Banks, traumatized by the bad debt crisis of the 1990s and facing continued deflation, became extraordinarily risk-averse and reduced lending even when interest rates were zero, and the central bank flooded the system with liquidity. Between 2001 and 2006, the Bank of Japan implemented quantitative easing, expanding its balance sheet from approximately 20% of GDP to over 30% of GDP. The central bank purchased government bonds and other assets, directly injecting money into the financial system. Traditional monetary theory predicted this would generate inflation and stimulate economic activity. It did neither. The velocity of money, the rate at which money circulates through the economy, declined steadily as the newly created money sat idle in bank reserves rather than flowing into the real economy. This created a liquidity trap identical in mechanism to the 1930s United States, but different in origin. In the U.S., the gold standard imposed an external constraint that initially prevented monetary expansion. In Japan, no such constraint existed. The BOJ was free to create as much yen as it wished. Yet the result was the same. Monetary expansion became impotent. Injecting monetary base into the economy had no effect because base money and bonds were viewed by the private sector as perfect substitutes. If you were a Japanese bank in 2003, your calculation was brutally simple. The Bank of Japan offers you unlimited liquidity at zero cost. But who do you lend to? Businesses don't want to borrow because demand is weak and prices are falling. Households don't want to borrow because deflation makes saving more attractive than consuming. Real estate investors don't want to borrow because property values continue declining. So you take the central bank's liquidity and hold it as excess reserves, earning a small but positive return with zero risk. The evidence demonstrates the trap's persistence. Japan's unemployment rate reached its highest levels in the post-war period during the late 1990s and early 2000s, despite monetary policy being as expansionary as theoretically possible. GDP growth averaged barely 1% annually through the 1990s and 2000s, hence the term lost decades. And inflation, the Bank of Japan's explicit target of 2%, remained elusive until the global inflation surge of 2021-2023 finally helped Japan reach sustained positive inflation for the first time in over 2 decades. This brings us to a crucial observation. Japan's experience with quantitative easing from 2001-2006 and again after 2013 under Abenomics provided real-world evidence of monetary policy's limitations at the zero lower bound. The Bank of Japan became one of the largest owners of Japanese government bonds, holding a substantial portion of outstanding debt on its balance sheet. It purchased equity ETFs. It implemented negative interest rate policy in 2016, actually charging banks for holding excess reserves. Nothing worked to generate sustained inflation and robust growth. Based on historical precedent, Japan's liquidity trap demonstrated that once deflationary expectations become entrenched, breaking them requires more than monetary expansion alone. The real interest rate, suitably risk-adjusted, remained too high in Japan to stimulate aggregate demand, even when nominal rates were negative, because the deflationary psychology and expectation of continued price declines dominated economic decision-making. The pattern is absolute. Stage 1. Asset bubble collapse destroys wealth and confidence. Stage 2. Deflation or very low inflation becomes expected by households and businesses. Stage 3. Central bank lowers nominal rates to zero or below. Stage 4. Real interest rates remain positive due to deflation or low inflation expectations. Stage 5. Monetary expansion becomes impotent as money velocity collapses. Stage 6. Economy remains trapped in low growth, low inflation, and high savings rates for an extended period, measured in decades, not years. Japan entered this trap in 1991. 34 years later, despite every monetary tool in the central bank's arsenal being deployed repeatedly, Japan only recently achieved its 2% inflation target, and primarily due to global factors beyond the Bank of Japan's control. Let me show you why this matters. The liquidity trap is not simply an academic curiosity or a historical anomaly that affects only certain nations under specific circumstances. It is a fundamental breakdown in the transmission mechanism of monetary policy, the process by which central bank actions influence the real economy. Here's how this works step by step. Step 1. A central bank creates money. In the modern financial system, this is done through asset purchases, quantitative easing. The Federal Reserve, for example, creates reserves and uses those newly created reserves to purchase treasury bonds or mortgage-backed securities from banks and other financial institutions. The sellers receive payment in the form of bank reserves held at the Federal Reserve. Step 2. Banks receive these reserves. Under normal conditions, banks treat reserves as hot potatoes. They don't want to hold them because they can earn higher returns by lending to businesses and households. So they lend aggressively, and that lending creates new deposits through the money multiplier effect. If the reserve requirement is 10%, every dollar of reserves the central bank creates can theoretically support $10 of new loans and deposits in the broader economy. Step 3. This credit expansion lowers interest rates across the economy, making borrowing cheaper for businesses and households. Lower interest rates stimulate investment and consumption. Businesses borrow to expand. Households borrow to buy homes and cars and appliances. Aggregate demand increases. Step 4. Increased aggregate demand drives up prices. Inflation rises toward the central bank's target, typically around 2%. Rising prices increase nominal GDP. Higher nominal GDP means debt burdens become easier to service because revenues grow while the nominal value of existing debt remains fixed. This positive feedback loop supports continued economic expansion. This is the textbook transmission mechanism of monetary policy. It worked in the 2000s. It worked after the 2008 financial crisis. It worked, to a significant extent, in 2020-2021. But here's the key question. What happens when Step 2 breaks down? What happens when banks receive reserves from the central bank but don't lend them out? What happens when businesses and households don't want to borrow even at 0% interest rates? You enter a liquidity trap. At the zero lower bound on nominal interest rates, the opportunity cost of holding cash becomes zero. If the interest rate is zero, you earn nothing by lending your money to someone else, but you also lose nothing by holding it as cash. Cash and interest-bearing bonds become perfect substitutes from the perspective of an investor. This causes a critical shift in behavior. Under normal conditions with positive interest rates, there's a clear incentive to lend or invest rather than hoard cash. You earn a return. But when rates hit zero and deflation persists or is expected, holding cash becomes not just equivalent to bonds, but superior to risky investments. Cash guarantees purchasing power preservation and even gains in real value if prices fall. Lending or investing risks losing principal if borrowers default or investments fail. Now add deflation to this scenario. If prices are falling at 2% per year and the nominal interest rate is zero, the real interest rate, the rate that actually matters for economic decisions, is positive 2%. Think about what that means for a business considering whether to borrow and invest in new equipment. At a 2% real interest rate, the equipment must generate returns exceeding 2% per year just to break even on the financing cost. But if deflation is happening, it likely means demand is weak. Weak demand makes earning any positive return difficult, let alone returns exceeding 2%. The rational choice for the business is not to borrow. The rational choice is to delay investment, cut costs, and hoard cash. And when thousands or millions of businesses make this same rational choice simultaneously, aggregate demand collapses further, intensifying deflation and validating the decision not to borrow or invest. For households, the calculation is similar and equally devastating. If prices are falling 2% annually, the purchasing power of cash increases 2% annually without any effort or risk. This makes delaying consumption rational. Why buy a car today for $30,000 when you can wait 1 year and buy it for $29,400 with the same amount of cash? But when millions of households delay consumption simultaneously, businesses see falling demand, which forces them to cut prices further, which validates the household decision to delay consumption, which reduces demand even more. This is the deflationary spiral. And here's what's crucial. Monetary expansion cannot break this spiral once it becomes entrenched. The Federal Reserve can create $1 trillion of new reserves, but if banks don't lend those reserves because businesses and households don't want to borrow, the money never enters the real economy. It sits as excess reserves in the banking system, inert and impotent. The data reveals this with stark clarity. In the United States, the velocity of money, measured as nominal GDP divided by M2 money supply, has collapsed from 2.2 in 1981 to 1.12 in Q2 2024, a 49% decline. Between 2008 and 2024, the M2 money supply expanded dramatically, growing from approximately $8 trillion to $22.2 trillion in September 2025, an increase of 178%. Yet nominal GDP did not triple. Why? Because the velocity of money collapsed. The newly created money circulated through the economy at half the rate it did in the 1980s. M2 growth averaged 23.6% in 2020 during the pandemic response, representing an unprecedented expansion of the money supply. Traditional monetary theory predicted this would generate massive inflation immediately. It did not, at least not right away, partly because velocity declined sharply during the same period. The money existed, but it wasn't being spent and respent rapidly. It was being hoarded, saved, or used to pay down debt rather than circulating through consumption and investment. This is the pushing on a string phenomenon. A central bank can create money, but it cannot force that money to circulate. It can lower interest rates to zero, but it cannot force businesses to borrow and invest. It can inject liquidity into the banking system, but it cannot force banks to lend to risky borrowers. And when deflationary expectations or insufficient aggregate demand dominate economic psychology, all the monetary expansion in the world becomes impotent. The pattern repeats across history. United States, 1933 to 1941. Monetary base expansion with persistent deflation and stagnation. Japan, 1995 to 2020. Zero interest rates and quantitative easing with minimal inflation and low growth. The mechanism is identical. The timing is inevitable. Once the trap closes, monetary policy alone cannot open it. Which brings us to now, or more precisely, to the recent past when the playbook still functioned. September 15, 2008, New York City. Lehman Brothers files for bankruptcy with $613 billion in debt, the largest bankruptcy filing in United States history. Credit markets freeze. Interbank lending stops. The financial system stands on the edge of complete collapse. The Federal Reserve responds with unprecedented aggression. The federal funds rate is slashed from 5.25% in mid-2007 to effectively zero by December 2008. But conventional rate cuts prove insufficient, so the Fed launches quantitative easing, QE1, QE2, QE3, Operation Twist, purchasing trillions of dollars in treasury bonds and mortgage-backed securities. The Fed's balance sheet explodes from approximately $900 billion in 2007 to $4.5 trillion by 2015. This represents an expansion of 400% in less than 8 years, and this time, it works. Not perfectly, not quickly, but it works. GDP growth returns. Unemployment falls from 10% in 2009 to under 4% by 2018. Asset prices recover and then surge to new highs. Why did it work in 2008 when it failed in Japan throughout the 1990s and 2000s? The critical difference was deflationary expectations. In the United States in 2008-2009, there was a brief deflationary scare. Prices fell for several months, and there was genuine fear of a deflationary spiral like the 1930s. But the Federal Reserve's aggressive response, combined with massive fiscal stimulus, prevented deflationary expectations from becoming entrenched. Households and businesses expected inflation to return to around 2% over the medium term. That expectation was crucial. If you're a business in 2010 and you expect 2% inflation over the next decade, borrowing at a 3% nominal interest rate means your real borrowing cost is only 1%. That's cheap financing. You might borrow to invest. If you're a household and you expect 2% inflation, sitting on cash means losing 2% of purchasing power annually. Better to buy that house or car now rather than wait. These decisions, aggregated across millions of actors, drive demand higher and generate the inflation that was expected, a self-fulfilling prophecy in the positive direction. But here's what's crucial. The 2008 recovery was incomplete. Inflation remained persistently below the Fed's 2% target for most of the 2010s, averaging closer to 1.5%. Wage growth remained sluggish, labor force participation declined, and the velocity of money continued its long-term decline, falling from 1.7 in 2008 to 1.4 by 2019. The Fed had prevented disaster, but it hadn't restored genuine economic vitality. The economy operated below potential for years. Then came March 2020. COVID-19 pandemic triggers economic lockdowns globally. Unemployment in the United States spikes to 14.7% in April 2020, the highest level since the Great Depression. Economic activity collapses by double digits in the second quarter of 2020. The response is even more dramatic than 2008. The Federal Reserve cuts rates to zero again and launches quantitative easing again, but this time on steroids. The Fed's balance sheet expands from $4.2 trillion in February 2020 to $8.9 trillion by April 2022, an increase of $4.7 trillion in just 25 months. This dwarfs the expansion during 2008 to 2015. But monetary policy is not alone this time. Fiscal policy goes into overdrive. The CARES Act, the American Rescue Plan, and other stimulus measures pump trillions of dollars directly into households and businesses. Money supply growth hits 23.6% in 2020, an unprecedented peacetime expansion. And this time, it works too well. Inflation, dormant for over a decade, returns with a vengeance. By 2021, inflation exceeds 5%. By 2022, it reaches 9%, the highest level in over 40 years. The combination of massive monetary expansion and massive fiscal stimulus, delivered while supply chains were disrupted and labor markets were dislocated, generated more inflation than policymakers expected or intended. The pattern seemed broken. Central banks appeared to have solved the problem of how to generate inflation and escape the zero lower bound. But did they? Or did unique circumstances, a global pandemic requiring lockdowns, fiscal stimulus of unprecedented scale delivered directly to households, supply chain disruptions creating genuine scarcity, create conditions where monetary and fiscal policy could gain traction? Based on historical precedent, the latter is more likely. The 2020-2021 recovery worked not because the fundamental mechanics of monetary policy had changed, but because fiscal policy did the heavy lifting, and unique supply-side constraints created genuine scarcity that monetary expansion could convert into price increases. Remove those unique factors, and the underlying vulnerabilities remain: high debt levels, low velocity of money, aging demographics that naturally suppress demand, and an economy structurally different from the high-growth environments of the mid-20th century. And in 2025, those unique factors have vanished. The pandemic is over, fiscal stimulus has ended, supply chains have normalized, but the structural problems have intensified. The United States debt-to-GDP ratio stands at 120.9% as of June 2025, compared to 99% projected for 2024 and 31.8% in the early 1980s. This represents an increase of nearly 400% in the debt burden relative to economic output over 4 decades. Here's where it gets explosive. The Congressional Budget Office projects federal debt held by the public will rise from 99% of GDP in 2024 to 116% by 2034, and if current policies continue, to 172% of GDP by 2054. Interest payments on this debt are exploding. Net interest costs more than tripled from $231 billion in 2014, representing 1.3% of GDP, to $799 billion in 2024, or 3% of GDP, the highest ratio since 1996. According to the Committee for a Responsible Federal Budget, the U.S. government now spends more servicing its debt than it does on national defense. Think about what that means. Every dollar of tax revenue that goes to interest payments is a dollar that cannot be spent on infrastructure, education, defense, or social programs. And as debt levels rise and interest rates remain elevated relative to the 2010s, this burden grows heavier every year. By 2034, interest costs could consume 15 to 20% of all federal revenue. This is not sustainable. Meanwhile, the velocity of money remains at historically depressed levels, 1.12 in Q2 2024, barely changed from the pandemic lows, and down 49% from 1981. M2 money supply reached a record $22.2 trillion in September 2025, up 4.6% year over year. But this growth rate remains below the long-term average of 6.3% from 2000-2025. The money exists, but it's not circulating. This brings us to the central question: what happens when the next crisis hits? What happens when recession arrives, or financial stress emerges, or geopolitical shocks disrupt markets? The Federal Reserve will do what it always does: cut rates and launch quantitative easing. But this time, the conditions are fundamentally different. First, interest rates started the current tightening cycle at much lower levels than historical norms. The effective federal funds rate peaked at approximately 5.5% in 2023 during the inflation-fighting campaign. Compare this to previous cycles. Rates reached 19% in the early 1980s under Paul Volcker, 6.5% in 2006-2007 before the financial crisis. The Fed has far less room to cut before hitting the zero lower bound again. Second, the balance sheet is already bloated. Even after quantitative tightening that began in 2022, the Fed's balance sheet remains massive by historical standards. The Fed has indicated it will permanently maintain a large balance sheet and intends to slow and then stop the decline. This means when the next crisis hits, the Fed starts from a position of already having its balance sheet expanded far beyond pre-2008 norms. How much more can it expand before diminishing returns or outright impotence sets in? Third, and most critically, research suggests central bank balance sheet policies may be less effective than previously thought. According to analysis by the European Central Bank, this could be an additional factor explaining why large-scale asset purchases did not succeed in bringing inflation back to 2% before the pandemic. By doing quantitative easing, central banks absorb fiscal deficits and thereby lower the natural rate of interest, potentially making monetary policy less effective at stimulating the economy. The mechanism works like this. Fiscal deficits absorb private savings and increase the natural rate of interest. But when central banks purchase government debt through QE, they effectively absorb those fiscal deficits, which lowers the natural rate of interest back down. This creates a situation where QE may be counteracting its own intended effects, trying to stimulate the economy by lowering long-term rates while simultaneously lowering the natural rate of interest in a way that reduces the effectiveness of that stimulus. Now add the demographic headwinds. Aging populations in developed economies naturally save more and consume less. This increases the savings rate and reduces aggregate demand structurally, independent of monetary policy. It also increases demand for safe assets like government bonds, which keeps yields low and makes it difficult for central banks to generate the inflation necessary to reduce real debt burdens. The pattern is converging. Stage 1, high debt levels constrain fiscal policy's ability to respond to crisis. Stage 2, low natural interest rates limit monetary policy's room to cut. Stage 3, when crisis hits, central banks cut to zero quickly. Stage 4, insufficient aggregate demand and potentially deflationary forces emerge. Stage 5, central banks launch massive QE, but effectiveness is limited due to already expanded balance sheets, low natural rates, and structural factors like demographics. Stage 6, the economy enters a liquidity trap, where conventional monetary policy becomes impotent. History suggests that within 18 to 36 months of the next significant economic shock, developed economies, particularly the United States, will find themselves in exactly this position. The timing is inevitable. The mechanism is absolute. But what will trigger the next crisis? One emerging scenario centers on a dollar liquidity crunch. According to analysis by financial experts, the Federal Reserve faces mounting pressure to restart quantitative easing due to increasingly strained liquidity conditions in financial markets. Here's the mechanism. As the Treasury rebuilds its account at the Federal Reserve following debt ceiling increases, dollars are withdrawn from the banking system. Banks see their reserve balances decline. When reserves fall below certain thresholds, liquidity shortages emerge in critical markets like the repo market, where financial institutions borrow and lend on an overnight basis using Treasury securities as collateral. The Federal Reserve faces a critical choice: allow the banking system to experience severe liquidity shortage or implement new quantitative easing to replace the dollars being removed from circulation. The consequences of insufficient liquidity could be catastrophic, potentially triggering a global financial recession. Given this reality, analysis predicts QE will resume weeks, not months, after debt ceiling hike, suggesting the Federal Reserve will choose system stability over monetary discipline. The timeline could unfold rapidly. With debt ceiling deadlines approaching around mid-2025, according to some estimates, the process could trigger market stress within weeks of the debt ceiling increase. The Treasury would rebuild its account. Bank reserves would decline. Repo market stress would become evident. And the Federal Reserve would likely respond with new quantitative easing. But here's what's different this time. The QE that the Fed would launch would be entering an economy already saturated with money that isn't circulating effectively. The velocity of money is at record lows. Banks are already holding massive excess reserves. Businesses and households have demonstrated low appetite for borrowing even at historically low rates. Adding more reserves to this environment is like adding gasoline to a flooded engine. It doesn't help. As one analyst explains, QE injects reserves by buying assets, especially treasuries. Dollars become backed by those assets. But if the Fed buys treasuries, dollars are backed by promises for future dollars, a circular collapse waiting to happen. This system requires continuous expansion to avoid collapse, similar to a neutron star that must maintain precise conditions to avoid imploding into a black hole. Once started, quantitative easing becomes increasingly difficult to unwind without triggering the very crisis it was designed to prevent. Think about what this means for the transmission mechanism of monetary policy. If QE restarts in 2025 or 2026 in response to a liquidity crunch or recession, the Federal Reserve will be purchasing assets that are effectively promises to pay future dollars, using newly created present dollars. The backing of the currency becomes increasingly circular and abstract. Confidence in the currency depends on confidence in the government's ability to repay or refinance its debt indefinitely. But with debt-to-GDP ratios approaching 125% and rising, and interest costs consuming an ever larger share of tax revenue, that confidence could erode. If confidence erodes while the Fed is simultaneously expanding its balance sheet, you get the worst possible outcome. Monetary expansion that fails to stimulate the real economy but succeeds in generating inflation through currency debasement rather than genuine economic growth. This is not the healthy 2% inflation that central banks target. This is stagflation, stagnant growth combined with rising prices, or potentially even the early stages of a loss of confidence in fiat currency itself. The data points in this direction. M2 money supply expansion continues to trail the combined pace of real GDP growth and inflation, yet recent rebounds signal a shift from post-pandemic monetary tightening toward renewed liquidity growth. This raises questions about future inflation pressures in an environment where velocity remains suppressed and real economic growth remains moderate at best. The liquidity trap of 2025 is not the liquidity trap of 1933 or even 1995. It is a trap built on decades of debt accumulation, multiple rounds of quantitative easing that have already expanded central bank balance sheets to unprecedented levels, structurally low velocity of money that shows no signs of recovering, and demographic forces that suppress demand independent of monetary policy. When the trap closes this time, the tools available to escape are far weaker than in previous episodes. Based on historical precedent and current trajectories, here is what the data suggests will unfold. Between mid-2025 and late 2026, the Federal Reserve will face a crisis that forces a policy response. This could be a recession, a financial market disruption, or a dollar liquidity crunch as described. The exact trigger is less important than the structural conditions that make a crisis likely within this time frame. When crisis emerges, the Fed will cut interest rates rapidly, likely taking the federal funds rate from current levels to zero within 6 to 12 months, similar to the pace of cuts in 2008 and 2020. This will exhaust conventional monetary policy almost immediately, given that rates are not starting from the 5% plus levels that provided room to cut in previous cycles. With conventional policy exhausted, the Fed will restart quantitative easing by late 2025 or early 2026 at the latest. The initial scale will likely be $100 to $200 billion per month in asset purchases, similar to the pace during QE3 in 2012 to 2014, or potentially larger if the crisis is severe. The Fed's balance sheet will expand from its current level toward $10 to $12 trillion over the following 18 to 24 months. But this time, the effects will be muted. GDP growth will remain sluggish, averaging 1 to 1.5% despite massive monetary stimulus, similar to Japan's experience through the 2000s and 2010s, rather than the U.S. recovery after 2008. Inflation will remain below the Fed's 2% target, or will fluctuate erratically, failing to achieve stable 2% inflation as deflationary forces from high debt levels, aging demographics, and low velocity of money counteract the monetary expansion. Unemployment will likely rise to 6 to 8% during the crisis and remain elevated even as the Fed maintains zero rates and expanded balance sheets. This is consistent with liquidity trap dynamics, where monetary policy loses its ability to stimulate hiring and investment. By 2027-2028, it will become clear that monetary policy is not generating the recovery that policymakers expect or promise. At this point, three scenarios become possible. Scenario 1. The economy remains trapped in low growth, low inflation, and elevated unemployment for an extended period, measured in years or decades. The Japan outcome. Probability: 40%. Scenario 2. Political pressure builds for massive fiscal stimulus to break the trap, similar to how World War II fiscal spending finally ended the Great Depression liquidity trap. This could take the form of infrastructure spending, universal basic income, or other direct fiscal transfers that put money into circulation, regardless of private sector willingness to borrow and spend. This would likely work to generate growth and inflation, but at the cost of exploding debt-to-GDP ratios toward 150 to 180% by 2030, raising long-term sustainability questions. Probability: 35%. Scenario 3. The Federal Reserve, desperate to generate inflation and avoid the Japan scenario, maintains QE so long and at such scale that confidence in the dollar begins to erode, triggering currency debasement and higher inflation through loss of confidence rather than genuine economic growth. This is the stagflation, or crisis of confidence scenario. It would manifest as inflation rising to 4 to 6%, while GDP growth remains below 2%, the worst of both worlds. Probability: 25%. All three scenarios share a common element. Conventional monetary policy, cutting rates and doing QE, will prove insufficient to generate robust economic recovery in the 2025 to 2030 timeframe. The liquidity trap will close. And unlike 2008 or 2020, the unique factors that allowed monetary expansion to work will be absent. If you are an investor in 2025, your portfolio should be positioned for an extended period of low growth, unstable inflation, and heightened policy uncertainty. If you are a worker or business owner, you should prepare for an environment where traditional economic relationships break down, where more money printing doesn't lead to more growth, where zero interest rates don't lead to investment booms, where the rules that govern the economy for the past 40 years no longer apply. History shows that liquidity traps, once established, persist for extended periods. The United States from 1933 to 1941, 8 years. Japan from 1995 to 2020, 25 years. The duration depends on the willingness of policymakers to pursue unconventional policies, massive fiscal stimulus, debt restructuring, or, in extreme cases, monetary system redesign. The evidence demonstrates that hoping monetary policy alone will save the economy is futile once the trap closes. The printing press stops working. Not because central banks can't create money, they can, infinitely, but because creating money no longer translates into economic activity when the transmission mechanism is broken. The timing is inevitable. Between 2025 and 2030, the developed world, led by the United States, will rediscover the lessons that the 1930s taught and Japan relearned in the 1990s. There are limits to monetary policy, and those limits are reached at the zero lower bound when debt is high, demographics are unfavorable, and deflationary forces are structural rather than cyclical. The pattern is absolute. 3 times in modern economic history, the same mechanism has produced the same outcome. Monetary expansion becomes impotent, conventional policy fails, and economies remain trapped in stagnation for years or decades. In 2025, the United States and much of the developed world stand on the edge of this trap. Debt-to-GDP ratios above 120%. Velocity of money down 49% from historical norms. Central bank balance sheets already massively expanded with limited room to expand further effectively. Demographic headwinds that structurally suppress demand. and a political and economic system that remains in denial about the fundamental limits of monetary policy at the zero lower bound. This is not speculation, this is mathematics. The numbers do not lie. When the next crisis hits, whether in months or within the next 2 years, the Federal Reserve will cut rates to zero, launch quantitative easing, and discover that the tools that worked in 2008 and 2020 no longer function in 2025 or 2026. The transmission mechanism is broken. The printing press has stopped working. What seemed impossible is now inevitable. An era where more money printing makes the economy weaker, not stronger. Where zero interest rates fail to stimulate borrowing and investment. Where central banks become impotent observers of economic stagnation they can measure but cannot remedy through conventional tools. If this changed your perspective on what's coming in the next 5 years, subscribe, because when this pattern completes, when the liquidity trap closes and stays closed, you'll want to understand why everyone who promised that printing money would save us was wrong. You'll want to understand why the rules changed. And you'll want to understand what comes next when the most powerful economic tool of the past century stops working. The liquidity trap of 2025 is not like the ones before. This time, we enter with eyes open, with historical examples to learn from, and with data that shows exactly what's coming. But we enter nonetheless. The trap is patient. The trap is inevitable. And the trap is closing now.